Good morning and welcome to the weekly analysis session for the ETC, the Elite Traders Club, Monday the 12th of October 2015. Hope everyone's had a good weekend. The weather in Melbourne has been very Melbourne-like, beautiful over the weekend and then continued to pour overnight with lots of rain, so very seasonal for this time of the year, as is always in Melbourne, 4 seasons in one day. The disclaimer: the content of today's presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, nor particular needs. So please, before making an investing decision, based on the general advice presented in any of our presentations, please consider whether that advice is appropriate in light of your financial circumstances. All right, the disclaimer out of the way. Let's proceed. As usual, portfolio management. We're going to see what's happened with the market risk over the last week. You might remember last week in both the US and the Australian markets, we dipped just into extreme market risk. Since that occurrence, the markets have rebounded very, very strongly, and in both markets, we happen to be sitting in very high market risk at this point in time. A couple of setups we'll have a look at. Couldn't find anything new in the ASX. I did manage to find 3 in the US, which we'll go through. We'll have a look at some orders that have triggered from previous dated setups. We'll also have a look at some trailed stops in both the US and the Australian market, but also a bit of a review again of the portfolio and just see how some of the stocks are tracking along the way and whether we've got any stocks there that are starting to regain some strength. And I think it always pays to go back and review the broader watch list. And again, remembering that to try and keep your job as simple as possible, we use that little green line, our trailing 3 ATR, as a guideline for staying in stocks, STOCKS, staying in our stocks, making it easy as possible. Once price closes below that little green line, then we are out at market on the next period. Right, so the benchmarking model at this point in time in the ASX, we are in very high market risk, so improving slightly from last week when we were in extreme risk. As such, we have to use a market risk multiplier of 20%. Now, this really applies to people who were traders or investors who are looking to enter the market for the very first time. Remembering, if you've been in the market for any length of time, your job is to continue to manage your trades in the appropriate way. That is, when price closes below that trailing stop, you need to get out. Rather than trying to reduce risk on every single trade and across your portfolio when market risk deteriorates, your job is, because you are choosing stocks that have good relative strength, is to stay true to your trading plan, be patient, have faith in the plan, and if the market volatility reduces, then your stocks are likely to benefit from that reduction in volatility and stay open. In the S&P 1500, the market risk there is very high, moving up from extreme risk last week, and again, 20% value at risk at this point in time. 20% of your normal value at risk that you are allowed to have. So obviously, we'll explain that a little bit more detail. So as an example here, if in the ASX, if you had a maximum allowable drawdown of 15% at the moment, because we're in very high market risk, you need to use a 20% market risk multiplier. Now, assuming that you are splitting your capital between both markets, that would mean 7.5% of your maximum allowable 15% is allocated to the Australian markets, and of that, you are allowed to expose 20%. That is 1.5%. So if you are new to the market, that's the only allocation, if you like, in terms of risk that you would have in the current market. If you're already in the market, your job, as I said, is to monitor your trades, manage them according to the trailing stop. If the market does continue to deteriorate over a period of time, eventually you'll be stopped out of your positions, not re-entering them until we get back into the lower market risk levels. So something for you to think about, something for you to practice along the way. The reason for doing so, it should be fairly obvious that if you continue to strangle your trades and reduce value at risk by raising those stops too aggressively, you're almost guaranteeing that you're going to be stopped out of your trades, only to see the market make a recovery and pull back. And you need to remember that in many instances, particularly in a rising market, we're going to get retracements of somewhere around about 10% every, perhaps once a year. We're going to get retracements of probably somewhere between 5 and 10% a couple of times a year. So you want to make sure that you're not reducing your exposure during those periods, because if you do that through strangling your trades, you're going to find that more than likely you're going to be stopped out, and when the market recovers, it's left you high and dry and not taking that increase in performance with your portfolio. In the US, as explained, we're in very high risk at the moment. So again, a little improvement from extreme the previous week. And again, if you're entering the market for the very first time and you're trading in the US, you're really only wanting to have around about 1.5% of your total capital exposed as value at risk in that market. Those of you who are already in it, your job is just to manage your trades, as we've previously discussed. Just to recap from last Friday, Jeff and I did the macroeconomics analysis session. Talked a little bit about the Fed and their role in world economics at the moment, a little bit about the IMF. So certainly go and have a listen to that if you haven't already. And last week's education session was on the use of soft stops and some just different ways that you can use soft stops and some rules for managing your trades with those. So please don't forget the education sessions. They are every Wednesday. There's quite a number of different sessions now, so please go and have a look. They're all labelled, so you can, for your own ease of use, can go through and have a look and perhaps do a little bit of recap or learn some new concepts along the way. Let's go through and have a look at our markets now. The S&P 1500 we'll have a look at to start with. So what I've just drawn on here, as you're pretty used to, obviously, is our portfolio management overlay here. I've just put on there a longer term moving average, which is just a 200 period moving average, which is by and large a pretty good sort of bull market, bear market indicator, particularly when you're looking at this more on a monthly basis. So what you'd be looking at there, the equivalent of a 200-day EMA is on a monthly basis is about a 10 period moving average on a monthly basis. And when the index closes below that level, it typically tells us that we're very much into bear market territory. Now at this stage, the interesting it's going to be interesting over the next couple of weeks, because whilst we've closed below this longer term moving average here, and we're certainly down in last week, you'll remember, down in extreme, we're just now up into very high risk. Probably even this week, if we get a bit of carry through, because this does tend to lag, we may even find ourselves next week into back into high risk, and then moderate, and then low eventually if that pans out. The interesting thing here at the moment is, whilst we have obviously fallen out of what was, you might remember, very much a sideways moving market, where we were very much in a box type of situation for a long period of time, moving sideways, and then you might remember that we had this nasty candle on in here where we closed outside the box, which opened up a move to the downward side. That candle there that that made us fall out of the box there, that's still the most dominant candle. That one hasn't been challenged at all yet. The one below that certainly has. It was challenged by this guy over here, and certainly coming up past the midpoint of that candle. So that's been challenged. We're starting to move back up again, closing now pretty much a little bit above the midpoint of that candle. So the next main challenge for this market is to challenge this candle up here, but at the same time we've got this longer term moving average. Now what can happen is, once we've gone below the longer term moving average, we come back and we retest the old what was an old level of sort of dynamic support on the way up, whether that starts to act as dynamic resistance on the way down. Certainly up here it did. It'll be interesting over the course of this next week in particular to see how we react getting back up to those particular levels. So we just need to wait and see. Nothing much you can do about it. Just continue to manage your trades in the appropriate manner. Certainly I hope you're finding that through the sessions that we do on a Monday morning, and having a bit of a recap through the portfolio, that it's helping to give you the confidence to do the right things with your portfolio. That is, some of your stocks that you're going to get into your portfolio, they're going to be those that are actually going to hold up reasonably well. And your job is not to cull those because of fear, but just to manage them in the appropriate way. Because you never know which one of those stocks in your portfolio is going to retain its relative strength and hold up really well, and then when the market starts to move higher again, starts to outperform. There's been some really good examples this last week of particularly that, so we'll go through and have a look at that. The wrong way around there. Let's go back up to our local market, the ASX. So the XJO at this particular point, similar sort of story. You might remember that we've fallen below our longer term moving average. Certainly we haven't really come back and had a retest of it to any significant degree at this point. Interesting that we're starting to get back up towards this 5,400 level, and we're going to need certainly a close above there for the market to really regain some confidence. And again, this longer term moving average, as I said, tends to act as a level of dynamic support on the way up. So if we just sort of scroll out a little bit, you'll see that dynamic support along the way certainly gets breached every now and then, and it becomes a matter of whether it can find support above that level. And now the dynamic is starting to change a bit, where we're starting to see this our longer term moving average starting to act as dynamic resistance. So certainly it's going to be interesting over the course of the next couple of weeks to see what happens, because both of our markets are starting to come back up to those longer term exponential moving averages. Certainly if we can close above those levels and then put in a higher trough above that longer term moving average, that would be a very positive sign as well. Last week's education session, I also demonstrated what's called a volatility indicator, if you like, just down the bottom here. All this is just a percentage volatility, and on here that's the little red line. So as you can see, as this little red line moves up, it means that the average true range of the index in this case is increasing, so it's expanding. So you've got to remember that volatility is movement up and down. So it's not directional per se, but it just tells us how much movement, intraday movement, we get either up or down. And so you can see that this volatility is increasing, and this little green line is just a moving average, a 63 period moving average of the average true range of the index. So what does that tell us? Well, it just tells us that of recent times here, you'll see that the average true range, i.e. the volatility, is increasing. Okay. Now what you'll find is that because we are using a trend following system, the trend following system is going to work much better during periods of low volatility. So when we've got a rising, low volatile market, that's when we're going to get better performance out of the methodology. So just to put that into a little bit of context, if we just sort of zoom out for a period of time and think about the Australian market at the beginning of the year, we got off to a very, very good start. We put on about upwards of 10, close to 15% early in the year, and you'll see that our volatility was below its longer term moving average, and we had a nice movement upwards. So what I want you to just sort of think about is the relevance of volatility, its impact on the markets, and also in terms of trade management. So you'll see for long periods in 2014, which was a very good year on our markets, and that the volatility in terms of its average was below its average for a significant part of that year. And we had a very good run on the Aussie market, and a lot of stocks with showing really strong relative strength did very, very well, even though the index was a little bit up and down. But a much lower volatility style of market makes it a lot easier to put hay in the shed. So hopefully that makes sense. Certainly when we get an increase in volatility, these big range movements, it certainly becomes a lot more difficult, and that's where, you know, having those wider stops allows us to still be in the market, participating in stocks, because we're giving them much greater room to fluctuate and move around, and that even during the market downturns through here, as an example, that there are still stocks that will hold up, and when the market recovers, goes to deliver some nice profits for you. So again, let's just go and have a look at that in the US, because I think it makes good sense to go and have a little bit of a look. Certainly the clue, remember that we were travelling sideways in this ranging type of market. Our market indicator was coming down, and our volatility, if you like, our average true range, just as a percentage, was starting to increase, i.e. the little red line was just starting to get above the green line. And then all of a sudden, once we fell out of the width of the box, so to speak, volatility really expanded, and we've had these big up and downward movements as well, and hence the red line well above the green line. Those of you who've been trading the US for a period of time, certainly there's been some volatile periods, and this is typically what happens, is you'll get low volatility for a period of time, and then it begets high volatility, and then you'll get periods of high volatility, which will then settle down and become lower volatility again. So if you think about the markets, the US markets, those times when you've had really good runs in the US market, again during sort of halfway point of last year in the US market, you'll see the volatility really does drop off, and notice what happens with the index. It continues to move upwards, and so that's again, and you'll see your market risk indicator being in low market risk as well. So certainly when you've got low volatile markets, that's when you really start to make some money. When you're using a trend following system, volatility, again, that's the thing that sort of upsets your trend following system, and you'll get bouts of it from time to time. Certainly, as I said, you're going to get you're probably going to get a 10% correction around about once a year, and you're going to get a couple of, between 5 and 10% each year as well. And so during those sorts of corrections, again, you just need to be managing your portfolio in the simplest and easiest way that we've been describing for you. And then once volatility subsides, then those stocks that have got the good relative strength, they'll start to pick up very, very quickly and continue to put hay in the shed. So again, I hope that makes sense. If you want to know how to make that little indicator, it is covered in last week's education session. I actually gave the formula there in Beyond Charts, so if you want to go through and do that, by all means. All right, so let's go through and see if we've got any new setups for this particular week. I couldn't find any in the Australian market, but I could find a couple in the US. So let's just go through and have a look at those now, and then we'll go and have a look at do a little bit of a portfolio review or a watch list review. Now it's Monday morning, Beyond Charts. I'm sure it will come up any tick of the clock. Soon. There we go. It'll probably come up 2 or 3 times now. All right, so what I need to do, first of all, put on my weekly periodicity, and at the same time, I need to go through and go over to my analyses and pop that on. There we go. So BGS. All right, so interesting setup here in this particular stock. Point to note, at the end of August, when the market was going down at a rate of knots, this actually went the opposite direction, which was quite an interesting sign there. And obviously foods being more of a defensive type of sector, if you like, certainly seeing some money flowing into it. So when it was pretty much going sideways, it was underperforming compared to the rest of the market. And then when the US market really started to deteriorate, this really started to leap out, and as a result experienced a big increase in relative strength. The only thing we need to be thinking about is where are the last long-term peaks. So that's obviously one back here. We've already had our first test of that particular level. So the only thing we need to be thinking about is our price action on this one. So remember, our rule is that the last trough needs to be at or above the second from last peak. Well, there's our second from last peak. It's well clear of that. We've already had our first test of our longer term peak. We do need to zoom out and just make sure that there's nothing else that might obstruct the movement upwards. We're in blue sky, so that's all looking positive. So now all we need to do is set an on-stop order. So you might remember that the previous week, last week we did soft stops, the previous week's education, we talked about the concept of rather than using 2 pips, because 2 pips is not relevant when you're talking about stocks that are $80 compared to stocks that are $2 or stocks that are $500 or $1,000 or whatever. So we're just moving to a very simple rule that our on-stop order is going to be 0.5% above that last point of supply. So in this case, the last point of supply here is that last medium-term peak. So that last medium-term peak, if I just put the value line on there for everyone to see, that last medium-term peak is coming in at 37.78. Okay, 37.78. So what we're going to do is we're going to place an on-stop order 0.5% above that level. So the on-stop order is at $37.96 with a limit to 38.15. That limit is 1% above that last medium-term peak. So that last medium-term peak, 37.78, the limit is 1% above that. We're getting in on stop 0.5% above that level. Our protective stop, again, our rules need to be very, very simple. And our rules state that our protective stop needs to go at least 0.5% below our last medium-term trough, and we must be outside of 2 ATRs as a minimum. Remembering also, as a guideline, we're wanting our risk on the trade, that is, the distance between our entry and where our protective stop is, to be around about 10%. And that way we're going to get the best value for our money, if you like, our best position size, our best bang for our buck with those sorts of metrics. So that's the first trade that I found this week. That's on BG Foods. On stop at 37.96 with a limit to 38.15. Protective stop at 34.78. Next one. There we go. So here's a slightly different example. So we'll go through and have a bit of a look at this one. And let's just zoom out and see where we are. So you'll see that we are currently at all-time highs. So certainly something must be going on with this stock. The market likes it for a particular reason. I'm not too sure what the company does. I'm not all that interested. Very good relative strength. Price action, where is the trough compared to the second from last peak? It's well clear of it. So that's a very positive sign. Now you might notice up here in the comment that I've made, this is a stock, it's already moved 0.5% past the last medium-term peak. Okay, so it's already breached, if you like, our breakout level. Now I don't mind getting into a trade once it's past that medium-term peak, providing we can still get the structure of the trade where we're still risking, around about that 10% level, plus or minus a couple of percent. So giving yourself a little bit of a leeway, because we're at all-time highs, so we still need to place an on-stop order. So the question then becomes, well, how far above this last candle, and you'll see that last candle there, the high there is 102.34, and I'll just put the value line on so we can see. The high of the medium-term peak was 101.63. Now this wouldn't have come up in the scan last week because we didn't have a short-term uptrend. Now we've got a short-term uptrend, and that last candle, as I said, has just passed that last medium-term peak. That's okay. I'm still happy to get into this. It's a nice strong candle. A nice bullish candle, really good relative strength. So the question is, whereabouts do I place my entry order for that? So what I'm wanting to do is to enter at 0.5% above the high of the last candle. Okay, so 0.5% above the high. So the high of that last candle was 102.34. So I'm going to place a non-stop order 0.5% above that level. So that's going to be at 102.85 with a limit to 103.36. Okay, 103.36, and a protective stop is going to come in at $94.99, and that's outside of our 2 ATRs, and it's also at least 0.5% below our last medium-term trough. Okay, so that's LANC, Lancaster Colony Corporation. That was number 2, and I think there was one more in the list that I managed to find. Interesting that last week in your scans list, hopefully you noticed that there was a lot more stocks that were being spat out by the scan. So certainly a lot of stocks starting to experience, the trends all in alignment, increasing relative strength as a result. But at the same time, giving us feedback that the market is starting to move in the right direction. All right, here's an example of a stock. Last week we were in a short-term downtrend. Now we're in a short-term uptrend. Let's just scroll out for a moment, just see where we are in the scheme of things. Interesting. There's a long-term peak over here. All right, which I'll just draw in for you to have a bit of a look at. That's that little green line there, and what I'm going to do is just see what that high is. That high is 81.23. 81.23. So let's just move that 81.23 and pop that in. All right, let's just get rid of that value line for a moment. So that's a long-term peak. So typically what we need to have when we're coming up to a long-term peak is the first test. Now remember, we've also got a long-term peak through here, which we have already tested. We've had a first test of this previous one. So I'll just draw in another line there. I'll get rid of these in a moment. So there's a long-term peak there as well, which we've gone through, had our first test, price has come back and started to move through. So let's just blow this up a little bit. So that was the first one there, that first long-term peak, which we've tested, and it has obviously gone through. There's another long-term peak back prior to that one, but remember, the one that we're really concerned about is the most recent long-term peak. Okay, so at this point in time, I'll just move him out of the way as well. We've got a very dominant candle. Now, how far is too far before we get into a trade? Very interesting question, because at this point here, we are at all-time highs, okay? We haven't been above that level before. So the question is, when is it okay to still get into a trade? Well, as we said before, as long as you've still got all your trends in alignment, you've still got your increasing relative strength, as long as you can structure a trade where you're not going to be taking on any more risks than around about that 10%, plus or minus a couple of percent, just as a guideline, and it is just a guideline, then I don't see anything the matter with getting into a trade like that. Certainly, your protective stop must be below the last medium-term trough. So in this particular example, that last trough coming in there at 75.60, so we need to be at least 0.5% below that and at least 2 ATRs away. So in doing so, we will have a protective stop at 75.22. Now, if I'm going to enter this particular stock, where do I get in? Well, my rule says I need to get in at 0.5% above the most recent candle high. Remember, that candle high is a point of supply as well. So that candle high is at 83.43. So 0.5% above that level, I end up getting in at 83.84 with a limit 1% above that level, 84.26. Protective stop at 75.22. So we end up having, a little bit over $8, around about $8.60 risk on an $83 stock, and that gives us around about 11% risk on the trade. So that still fits in well within our guidelines. So certainly if you happen to see some trades that have passed your last medium-term peak, but you can still structure a trade appropriately, still showing good relative strength, the price action filter is an absolute must. So last trough at or above, second from last peak, then I don't see any reason whatsoever not to take a trade like that. So that one will go into the watch list this week as well. So they were the pendings that I had for the US. Guys and girls, did you manage to find any setups that I haven't gone through this morning in the US or even in the Australian market? If you've got any, let me know. What we might do while we wait for that is just go through and have a look at any stocks that triggered in the course of the last week. In the US market, one that did trigger was AIZ. This has been in the watch list for a little while now. AIZ, Assurant Inc. And I'm sure Beyond Charts will bring it up very soon. If I could sing, I would. AIZ, there we go. So we had a non-stop order at $80.10 with a limit to $80.90. Protective stop down at $70. So around about $10 risk on this one, with an $80 entry. Again, fitting in with that guidelines of around about 10% plus or minus. Triggering in last week, so not a bad candle last week. So that one goes into the watch list. And again, think about what's happened. Look at the relative strength on this compared to the broader market, showing some really good relative strength. A lot of white candles, and shaping up quite well. Again, that was AIZ. So that was one that did trigger. There were two stop outs in the US last week. VR was one of them. I'll go and have a look at that one. Okay, so you might remember a few weeks ago, this candle down here breaching the 2 ATR based initial stop. So therefore we had to put in a hard stop. The hard stop came in at 42.89, and last week, during last week's price action, coming down and triggering that hard stop. So that's VR. That will be coming out of the watch list. And the other one was ALR. So I'll go and have a look at him. And in this particular situation where we had our initial, the red line there is our initial 2 ATR based stop. Once price moved up, it dragged the ATR, the 3 ATR, up above our initial 2 ATR. So that is now the stop that we defer to. And last week, in fact, the previous week was starting to look pretty good. Look, nice white candle. Looked like we were going to get a bit of follow through, but last week it didn't occur, and price closed below its trailing 3 ATR. So that's a market exit tonight on ALR. Ken says nothing in ASX for months. No, it's been a little while since we've had anything sort of really set up in the ASX. Again, that's just because of broader market weakness. And you've got to remember, against that context, that's just market feedback. The market's telling us that there's not a whole lot going on at this point in time in the Australian market. Certainly there are some sectors that are starting to improve. The material sector is one. A lot of the miners, etc., are starting to increase in their performance, and that's helping to lift the broader market. However, we're not getting any stocks. Remember, they've got to be outperforming before they're going to come up on our scans. They've got to make sure that all the three trends are in alignment. and then finally they've got to pass that price action filter as well. So it's not surprising at this point in time, but hey, remember, we're still in high risk territory, so certainly not running out wanting to put too much capital into the markets at this point in time, keeping in mind that the portfolio management system is telling us to only have a very small amount of capital exposed if this is the first time you've been into the markets. If you're already in the markets, then your job is to hang on to what you've got, managing it accordingly, and hopefully you've been able to be in some of the stocks in the ASX. So while we're talking about that, let's go through and have a look at the Australian market. We might go back to the top of the watch list and go through these. There's not a lot in the Australian watch list at this point in time. So I'll just go through to the top, just about there. Capilano Honey, again, nothing to do with this. We've had a couple of price volume volatility signals go off on that, so remembering that's always an opportunity for you to take half off the table, and then looking to add to that if you've got any new setups or any strength re-entering those particular levels. Certainly, Capilano Honey's been very good for the watch list and continues to move in the right direction. Auckland International Airport, just managing to hang on. Last week's candle, not all that flash. ARB, last week, trying to move up a little bit higher. We have got obviously a level of support overhead. We just need a nice close this week, and that'll drag that trailing 3 ATR up a little bit higher. BWP, again, a couple of wicks on the top of those last few candles. Really just in no man's land at the moment. Nothing to do on that one at this point in time. GHC, a couple of pin bars the last couple of weeks. There has been a price volume volatility signal about 3 weeks ago, so an opportunity to take a little bit of money off the table. We're certainly well past 1-to-1 on that one. A positive candle this week, and that'll drag that trailing 3 ATR up higher. So again, you've got to remember all these stocks have continued to move in an upwards direction despite the overall market weakness, and that's evidenced through the relative strength. So do the right thing, stick to your rules, and if the market recovers, then it's certainly going to benefit you big time. GOZ, really at this stage, again, no man's land. At this stage, it's just a matter of wait and see whether we get some more relative strength coming back in that or not. Nothing to do for the time being. James Hardie, same sort of thing there. ATR is still giving it lots of room to move. Remembering we're looking to be in these trades for, ideally 6 months plus. AZJ, last week, a little bit higher. High and higher low, so we're back into short-term uptrend. Again, needs to start finding a little bit more relative strength compared to the broader market. You'll notice last week a little bit less than what the market did, so it'd be nice to see a bit of money flow back into that and start to push that one back up. AHD, again, really strong. This one's actually got a trailed stop this week. You'll see the trailed stop there is now at 12.06. Really nice candle last week, and again, great relative strength. Doing very nicely indeed. APE, again, lots of space between it and its trailing stop. Nothing to do on that one. There was a couple of price volume volatility signals on that one. MNF really struggled ever since this one was triggered. Last week, not doing a hell of a lot, a little bit weaker than the broader market. Still nothing to do on that one for the time being. Blackmores, last Friday, at one stage, this was down around about 10%. I think on the Thursday it was down about 6% and closed almost pretty close to where it opened. So certainly, whilst there was a bit of profit taking in that one, it did manage to hold up reasonably well. There's also been, as you'd probably know, those of you who've been in it, there have been a couple of price volume volatility signals. One back here at $131. So certainly, taking some profits off the table at that level. But again, you want to let your profits run and looking for any opportunity to add back in. So that's the Australian portfolio. Let's go through and have a bit of a look at the US one, and we'll see what we can make of that. So we've gone through a couple of the closed trades. There were two that got stopped out last week. Trailed stops on the following: ACGL, Arch Capital. Is there anybody who has that in their portfolio? ACGL, Arch Capital. Did anybody have it in their portfolio to start with? Maybe they're not in it anymore. You should be. If you're in this at any point in time, you should certainly still be in it. Nothing says that we should be out of it. Yes, price did come down. It did breach the trailing stop, but price didn't close below and starting to move up really strongly. And again, that trailing stop moving up as well. So ACGL. FISV was another one. Last week, really nice candle, really good performance compared to the broader market. Certainly at this point in time, during the broader market weakness, it did come down and breach its soft stop, therefore got converted to a hard stop. Since then, has regained its strength, put in a nice high trough, and moving onwards and upwards, and that's looking really strong. That's FISV. Another one that trailed its stops, GPN, Global Payments. Not too sure if anyone's in that one. GPN, Global Payments, since triggering in, moved up, and against broader market weakness, came back down. But certainly since that point in time, hasn't closed below its trailing 3 ATR based stop. And last week, putting in a very, very strong candle. So if you're in that, well done. You should still be in it. And hopefully that's in some of your portfolios. That's GPN. Also WDFC, WD40 company. And again, last week, nice strong candle, and as a result, dragging up that trailing 3 ATR line. So moving in the right direction. A couple of other stocks that performed very well last week in the US market. EFX. So not quite doing enough to trail stops up just yet, but again, remembering our rules, we get out when price closes below our trailing 3 ATR based stop. So this was a candle which dragged our 3 ATR up past our 2 ATR based initial entry, and so therefore our green line is now the one that we use to manage our trades. And the rule says when price closes below, we need to exit. Price hasn't closed below, starting to regain some strength, closing, nice close, back up above $100, looking really good. That's EFX. MANH. Again, last week, putting in a reasonable candle start. The reason why I've got this one highlighted, we've now put in a higher medium-term trough, so it's starting to regain a little bit more strength. And again, quite a lot of white candles through here as well. So against broader market weakness, it's certainly held up very well. And again, if you're in this, if you've been in this, there's absolutely no reason for you to have been out of this at any point in time. Your rules say that you still need to be in it. That's MANH. Starbucks, SBUX. Just about a cup of coffee time, I think. Again, big scary week. That huge volatility that we had during that 1,000-point drop on the Dow at the end of August, beginning of September. Certainly during that week, it looked diabolical. Still closed with a white candle, and since then has really regained a lot of strength. Now forming a much higher trough. Good strong candle last week. That's on Starbucks, so performing really nicely. TSS, Total Service Systems, or System Services, is one that's really, again, putting in a nice new higher medium-term trough and really looking the goods to get past $50 and move onwards and upwards. Lots of nice white candles, really good relative strength, holding up really, really well. So certainly if you've been in that one, you should still be in it. WSO. Another stock last week putting in a quite a nice candle. So certainly finding a little bit of weakness through here, a little bit of relative strength starting to come out of it, but then last week putting in a really nice candle there, starting to increase in relative strength. Again, giving it nice wide stops and starting to move onwards and upwards again. So nice candle on that one, WSO. And the last one, PGR, Progressive Corp. And again, a few weeks ago, triggering in and then having that a big sell-off during the course of that end of August, still closing with a white candle, moving back up. Still haven't done enough to drag that trailing 3 ATR up beyond its initial 2 ATR base stop, but further strength this week and that'll start to drag that trailing stop onwards and upwards as well. So that's looking pretty good at this point in time. Folks, that's about all I've got for this week. Are there any questions, any observations, any comments? If not, that's okay. Again, just remember, patience with your investing, your trading. Let the rules dictate what you need to do. Don't try and second guess what the market's going to do. Make sure you're paying attention to the market risk. You've only got the amount of exposure that you should have. If you're new to the markets, that's a very small amount of capital exposed to only new positions. If you've been in the market for a while and you've got existing positions, then certainly don't be adding to them at this point in time. You just need to manage what you've currently got, and hopefully you're doing the right thing and you're able to benefit from the relative strength that the methodology helps you to find in the market. All right, folks. Well, if no further questions, then here we go. Will, able to realise that we're no longer too much on round numbers, but are there any that we should be concerned about, $100, etc.? Yeah, good question, Will. Look, I think probably what you need to do is to go through and have a look, because it tends to be a bit more stock specific, and you will see some that historically have some relevance to round numbers. By and large, I really don't worry about it too much, because most of the time at round numbers, you might get, a stock moving in a counter direction for a little while. But if the stock's got good relative strength, then the fund managers and those guys, the guys who are really driving this market, they don't care about round numbers. Okay, so the whole concept of round numbers, for the way I look at it, is look. It prevents you getting into too many stocks. Certainly, if you're worried about it, have a bit of a look at the stock's history and see if there's any relevance to it. And if that's a concern for you, then sure. If you don't want to take the trade, that's fine. But as far as I'm concerned and the watch list is concerned, it's really not going to make any difference to what I put on the watch list. I've seen far too many setups where prices have just cleared round numbers and gone on to be some, to deliver some really nice returns. So, but certainly, if it's something that you're concerned about, have a look at the history, and if you want to put that into your trading plan, then you can do that if you want to. But good question. All right. Well, if you've got any suggestions for any education topics or anything like that, feel free to send me an email. Don't forget, there's a long list of them in the education portal on the website as well. But other than that, stick with your trading rules, follow the plan, and we'll catch up with you same time next Monday. Thanks for listening. Bye for now.